All right, welcome to this explainer. Today, we're diving deep into the mechanics of high-probability order blocks and finally solving the ultimate trading mystery, the unexpected stop-out. If you've been trading for any amount of time, you know that exact sting, right? When your perfect-looking setup suddenly reverses, hunts your stop-loss, and then goes exactly where you thought it would? Yeah, it feels personal. Today, we're pulling concepts directly from an intensive trading masterclass to give you a highly structured, mechanical approach to the markets that takes the guesswork and the emotion completely out of the equation.
Okay, let's map out our journey real quick. We're going to cover 1. The stop-out problem, 2. The anatomy of an order block, 3. The 3 golden rules, 4. A live London session trade, and 5. The 1-minute entry strategy. Let's get right into it.
Section 1. The stop-out problem, the hidden trap. So we're starting with a scenario that honestly almost every day trader knows firsthand. It's the hidden trap that quietly drains accounts.
Look at that number, 99%. That is the staggering percentage of retail traders who think they found the absolute perfect setup just moments before the market completely flips on them. You map out your zone, you get tagged in, your profit targets are perfectly set, everything feels amazing, and then bam, stopped out. It literally feels like the market has a heat-seeking missile aimed directly at your stop-loss, doesn't it?
So why does this happen? What mechanical failure is turning your seemingly flawless entry into a sudden, painful loss? Well, the harsh truth? Most traders are just identifying the completely wrong blocks. They're trading old retail patterns, drawing lines based on, hope, and totally missing the real institutional footprints left by massive capital.
Which brings us to Section 2, Anatomy of an Order Block, the blueprint. To fix this stop-out problem, we've got to rebuild our understanding from the ground up.
Okay, here's the deal. An order block isn't just some random candle on your chart. It is the exact area where institutional volume kicks into high gear. If we're hunting for a bullish order block, we want to find that final aggressive sell candle right before a massive impulsive buy move. We call that the sell to buy candle. But why does this even happen? Well, think about it like this. If you're a massive institution and you need to buy a huge amount of currency without spiking the price, you have to engineer a sell-off first. You need to generate enough liquidity on the other side. So that final aggressive sell candle, that's the physical footprint of those large resting orders taking control.
But hold on, to actually confirm an order block's validity, you absolutely must find a fair value gap, or FVG. This gap is your undeniable proof that there's a true price imbalance. It means buyers stepped in with such insane urgency that sellers couldn't even step up to fill the space. Just look at a 3-candle sequence. If the wick of candle 1 and the wick of candle 3 have empty space between them, that's your fair value gap. It shows an utter lack of counterparties. And let me tell you, it acts like a giant magnet for future price action. Wherever you see this gap, there's an incredibly high likelihood that a valid order block is sitting right there.
Notice the stark visual difference here. On the left, we've got true imbalance. Perfect. But on the right, see how the wicks touch? If they touch, the gap is closed, and the setup is completely invalid. Scratch it. It doesn't matter how aggressive or exciting that move felt at the time, if those first and third wicks overlap even a little bit, there's no imbalance, which means there is no high probability order block. Period. We are only in the business of trading undeniable institutional urgency.
Moving right along to Section 3. The 3 golden rules, the high probability filter. Because, let's be real, finding a block is just step 1.
These 3 golden rules, they are your non-negotiable checklist. Step 1, be pro-trend. Trading against the broader market current is just a recipe for disaster. Don't try to trade bearish order blocks when the market is clearly printing higher highs. Step 2, there must be a run on liquidity. Your order block needs to sweep old lows or old highs right before the aggressive move. It's essentially grabbing fuel for the reversal. And step 3, that block must lead to a break of structure. It has to actually accomplish something by breaking previous market geometry. That proves the big players are truly in control, not just testing the waters.
Section 4, Live Trade London Session, Theory into Practice. Time to bring all this theory to life on a real chart.
Let's walk through a real euro to US dollar setup during the London session. We're going to track the market phases sequentially, watch how the Asia session builds liquidity, and then the London Open sweeps those lows to trigger our market structure shift. Now, the Asia session is notorious for creating these tightly bound, highly liquid channels. Retail traders are happily stacking their stops just above and below this range while they sleep. What do? We sit back. We wait for the high-volume London Open to manipulate that built-up liquidity.
First things first, we establish our directional bias on the 30-minute chart. Here, we can see a clear shift from a bearish downtrend to a bullish structure. We had a series of lower lows, but that shifts entirely when price prints a definitive higher high. Boom. Now our bias is firmly locked in. We are only looking for long positions, no exceptions.
Then comes the patience phase. And yeah, I know, this is often the hardest part for any trader. We have our pro-trend bias, and we've got our valid bullish block with a fair value gap sitting beautifully right below the Asia lows. Now, you literally sit on your hands. You do absolutely nothing until price sweeps that Asia liquidity and drops right into your zone. Let the market do the heavy lifting. Let it come to you.
Finally, Section 5, 1-minute entry strategy. Precision execution, because getting to the zone isn't the whole story.
Once price taps our higher time frame zone, we don't just blindly enter. Honestly, entering blindly and just crossing your fingers that the zone holds is exactly how that 99% of traders get stopped out. Instead, we drop down to the 1-minute chart. It's like looking through a microscope. Now, as price drops into our 30-minute zone, this 1-minute chart is going to look aggressively, almost terrifyingly bearish. Don't panic. We just wait for that 1-minute chart to break a structural high. We want to see sudden displacement, undeniable proof that massive buyers have actually stepped back in to defend the zone.
As soon as we see that 1-minute displacement, we hunt for our final entry trigger, a fresh 1-minute order block with the valid fair value gap. Notice what we're doing here. We are applying the exact same 3 golden rules, just on a microscopic scale. We want that sweep of liquidity, that break of structure, and that imbalance. That tiny, precise gap is exactly where our limit order goes. We're letting the fractal nature of the market work for us.
This strict mechanical approach allows for an incredibly tight stop loss, tucked safely right below the 1-minute block. And that sets up a minimum risk-to-reward ratio of 1 to 5. To put that into perspective, with a 1 to 5 ratio, you could literally lose 4 trades in a row, win just 1, and still be highly profitable. Because our zone is so radically refined, a simple run to the next logical high on the chart nets you 5 times your initial risk.
But a quick word of warning. Before price hits that target, it often creates ranges. You have to understand that ranges are essentially pressure cookers. They are building liquidity traps on both sides of the market. Price will often stall and chop sideways right after you enter. Whatever you do, do not panic here. The market is just manufacturing stop losses on both the buy and sell sides to fuel its next leg up.
The market is sneaky. It'll routinely induce early buyers with a fake breakout, run their stops to grab liquidity, and only then move in its true intended direction. It pushes up, making everyone think it's breaking out to the moon, and then immediately reverses to sweep those newly created lows. But if your trade is mechanically sound and your stop is shielded by a true, valid order block, you will survive this exact manipulation.
In fact, if you understand this psychology and wait for a second valid structural shift during these ranges, you can even catch a re-entry offering a massive 1 to 6.85 payout. If you miss the first entry, this fake out isn't a missed opportunity at all. It's a pristine second chance. It creates a brand new run on liquidity, a brand new break of structure, and a brand new order block. You can actually compound your position all the way to the major take profit target for an enormous payout.
So, as we wrap up this explainer, I want to leave you with a final thought to take back to your own charts. The market is a machine designed to generate liquidity. So, will you patiently wait for the ultimate setup, or will you let impatience turn you into the market's liquidity? The difference between a sudden stop out and a massive reward really just comes down to mechanical discipline. Follow the rules, hunt for real imbalances, and trade with absolute purpose. Keep your focus sharp.